Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the Sahm Rule Recession Indicator, which has recently flashed its warning signal. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, before we go too far into the analysis of the Sahm Rule and this indicator that we actually done a video on, I believe about 8 months ago. And in that video, we just sort of forecasted that likely later on this business cycle that this metric would in fact trigger. What I want to do first is to say, look, these signals, when it first triggers, have mixed results as it relates to risk assets, right? So, of course, if you look at 2020, we had a crash. 2020 is not really your run of the mill recession, right? If you were to look at 2008, we had a crash shortly thereafter. In 2001, right? You can see that the market ended up going down quite a bit. Um, in 1990, you can see that when it triggered, the market only went down a little bit more, right? It wasn't another 40 to 50%. Um, in 1981, we can see when it triggered, the market went down, for a little bit longer, right? I mean, it didn't have like a catastrophic 50% drop, but the market did trend down for, maybe 6 to 12 months. When it triggered in 1980, you can see that the market dropped a little bit. When it triggered in 1974, the market actually had a pretty nice drop just after it. And in 1970, same thing, right? Just a drop right after it. But again, you can look at other times way back over here where once it triggered, that ended up marking sort of the low for that pullback. So I say this because this analysis in and of itself is not meant to convince you on what has to occur or what does not have to occur in the market. As you can see, there are very much mixed results. You have recessions that are accompanied by 50% drops in the stock market, and you also have recessions that only last for a really short period of time before the market just continues higher. Okay. So, it's impossible to know exactly what that's going to be. One of the reasons why sometimes the market sells off a lot more is if there's something very much to be fearful about, right? For instance, in the financial crisis, obviously the market was very worried about all the banks collapsing, and so the unemployment rate went up quite a lot. You can see just how high it went up. And so that led to a deeper recession than, say, your garden variety recession. So I just want to put that out there before we get into this, because I know some people will look at these videos and say, all right, well, because this is happening, they have to do something very specific with their portfolio. As I've said before, it's best to just have a plan, stick to it no matter what. I like to stick to the risk levels. I try to tune everything else out. It's just an acknowledgement that we cannot possibly know what's going to happen. With that said, I do think it's a good idea to at least have some understanding of the macro environment that we're in. And the reason I say that is just so that you can understand that if you are going to invest in something, as you get into recessionary type environments, there's going to be a continued flock to the safer assets within that asset class, right? So for crypto, that would be Bitcoin. For the stock market, it would be, the blue chip stocks that have, the best balance sheets, etc., right? So that doesn't mean that those assets can't come down, but what happens when you get into recessionary environments is it encourages the Federal Reserve to pivot to looser monetary policy until you reach a point where the higher risk assets start to outperform the lower risk assets. Now, we haven't made that switch yet, but it's probably coming relatively soon. So, now that I got that out of the way, I just want to talk about the Sahm Rule recession indicator. It is an indicator that is used and was developed by the economist Claudia Sahm. and is based on the idea that changes in the unemployment rate can be used to identify the onset of a recession. So essentially what it is the rule states that if the 3-month moving average of the unemployment rate increases by 0.5 percentage points or more above its 3-month moving average low for the previous year, it is considered a recession signal. So for instance, if you were to look at the unemployment rate and we were to then put on here a 3-month moving average, so that's a 3-month moving average. Let's take off the bull market support rate, a 3-month moving average. And then you look at where it was. So we just got the data for July 2024. So if you look at where it was in July of 2023, you can see that it was at 3.6%. That was the 3-month SMA. That was the low point over the last 12 months, 3.6%. Well, the unemployment rate today came in at 4.3%. And so the 3-month moving average of it is now at 4.13%. So 4.13 minus 0.36 is 0.53%. And the Sahm Rule again states that if it's just 0.5 percentage points, then it's considered a recession signal. So you can see it's actually at 0.53%. So as I showed previously, there's a lot of mixed results on what comes next. Whatever does come next, I would not expect it to play out in a predictable way. If you do have a larger drop in the stock market, which there's definitely precedent for, my guess is it's not going to play out how everyone on Twitter thinks it's going to play out. So let's just remind ourselves that, right? The market humbles all of us. And hopefully everyone has learned that at this point. I think this cycle has really done that for a lot of people. So it has been pretty reliable, though. Regardless of what happened to risk assets, when this metric triggers, it's a pretty reliable indicator of a recession. There's only one time where I can see where it really went up and triggered and then immediately came back down. When it did that, we still had a recession, right? And then it just went back up a few months later. So every time it's previously triggered, it has resulted in a recession. I believe the creator of this indicator, I could be wrong, but I'm pretty sure she's alluded to the idea that she doesn't think it's going to be a valid signal this time. But, my concern with that is that it kind of goes, and basically the reasoning, which is not necessarily bad reasoning, right, is just that the pandemic essentially has messed everything up, and it's made a lot of these signals not as reliable as before. There may be some truth to that, although I certainly could also envision a future scenario where, in 6 months or however long, right, we're all looking back and thinking like, well, why did we think this time was different? So normally thinking that this time is different is not something that works out that well. So again, its effect on risk assets, who knows exactly what it's going to affect. However, normally when the unemployment rate starts to move up and triggers this, the unemployment rate continues to go up. Meaning, whether you're an investor in risk assets or not, it's important to recognize that the labor market is softening up, and it might be worthwhile to prepare in case something like that were to happen, right? Again, I'm not offering financial advice, but it's just one of those things that it's okay to prepare for, right? Hope for the best, plan for the worst. So that's, and if you look at the unemployment rate, right? If you look at the unemployment rate and you look at it like with respect to its bull market support band, one of the things you'll notice is that once it really breaks above it, it then starts to go parabolic. And that's the issue with the unemployment rate is it doesn't always increase in a linear fashion, right? It can look like it's going up in a fairly predictable way for a long time. And then all of a sudden, before you know it, it starts to go parabolic, right? And it's hard to know exactly when that shift will occur. I mean, you can see that in prior cycles, right? In prior cycles, it was also a very slow process, right? If you were to overlay a bar pattern, so let's take the bar pattern of right here before the financial crisis, you can see that it's a long process for the unemployment rate, right? It's a really long process, and so it's not. I think a lot of people think that this time is different, but then when you look at it, you're like, well, is it really, right? Like, is it really different, or do we just think it's different? Sometimes when you look at a chart and you look at it and you're like, oh, it's taking forever, it's different this time. And then I go back and I look at these other periods, right? Even here with the .com, I look at these other periods and I'm like, when you overlay those periods onto this chart, they don't really look that different, right? They actually look the same. I think one of the issues for, for a lot of people, including myself, is that when you look at a chart like this, I think a lot of us just think about in terms of like days and weeks and maybe months. Maybe months. I think a lot of people have a hard time processing the fact that this takes place over years. When the unemployment rate bottomed in April 2000, it didn't top until 3 years later, right? This process took 3 years to play out, and the bottoming process just to get to the low, probably took a year from when it first was starting to show those some recessionary signals. And over here, I mean, when it first kind of got into this range, April of '06, the unemployment rate didn't top until October of 2009, right? So it took 3.5 years. So sometimes when you look at this stuff, I think it's easy to look at the unemployment rate and say, all right, well, it's different this time because, you know, the market is different, right? There's a lot of money printing, fiscal dominance. So it's different. And then I go back to this chart and I'm like, well, show me on the chart where it's different. Because when you overlay these two bar patterns from at least the last two recessions, it looks pretty similar, right? And you could even go back further to the 1990s. This was a milder recession, right? You don't always have to have 50% drops. And you overlay that and you're like, "Oh, it also looks the same." And you go back further, right? You go back even further to 78, 1979. You get that bar pattern, and we just shift it over. Let me grab this again. So we're gonna just shift this over right here, and once again, oh, like looks the same. So to some degree, I don't really think that this time is different. I just think that a lot of us, including myself, right? I'm not calling you out, well, a little, but really myself too, right? A lot of us think it's different, but then you overlay all these prior periods, and you're like, well, it actually looks basically the same, in terms of how long it took to build out a base, and then how long it took to slowly grind up. And then once it entered that parabolic phase, and in fact, you can kind of see that in all the last 3 to 4 that we just got, the last 4, they all basically entered this parabolic phase in the unemployment rate, or this nonlinear phase, at around this time in the business cycle, right? So it makes sense that the Sahm Rule has triggered, because the unemployment rate has started to move up in a nonlinear fashion, right? It's not, it's not just going up by 0.1% each month, right? Now it's 0.2%, and it was 0.1% for like 3 or 4 months in a row, and then people got comfortable with that, and then now it's 0.2%, and then it's like, well, what happens if next month you get another 0.2, and then another 0.2, right? That's how the unemployment rate, before you know it, it's at 5%, and it can sneak up on us. It can sneak up on us because of just how quickly it can start to move once it really starts to go. Now, at this point, the primary reason that the unemployment rate has gone up is actually because of an expansion in the labor force. To be completely honest, layoffs, all things considered, are still actually pretty low. And you could actually go look at initial claims. If you were to look at initial claims, they're at 249,000. I've previously said, I mean, you would really expect it to be in the 300,000 range to really be at recessionary levels. And we could certainly go there. I think a lot of people right now have been looking at this chart thinking, all right, well, it's just the same thing as last year, right? Where it went up and it kind of topped out in early August and then it came back down. I think there's a lot of people in that camp, that it's just more of a seasonal thing. But I guess the risk is what happens if August comes and goes and the and initial claims keep on going higher. Then this means it was actually a real climb in initial claims. That was not just something that was seasonal. Okay. So layoffs are actually still relatively low. But if you actually go back and look, I looked earlier, if you look at all the prior recessions, normally the early rise in the unemployment rate is actually primarily due to labor force expansion. What happens, and it makes sense when you think about it, what happens is a lot of the people that don't want to work previously because maybe they were just living off all the cash they had from the last cycle, that cash slowly starts to run out. Or if inflation really starts to eat away at their purchasing power. So as time goes on, they re enter the workforce. And when they can't find a job, that starts to contribute to the unemployment rate. Okay, so it makes sense that the earlier in the business cycle when the unemployment rate starts to go up, it's primarily driven by people who are entering the workforce who can't find it, who decided they want to get a job. Layoffs are not really that high yet, but that's how the unemployment rate could even go more parabolic, is if layoffs start to pick up and then you have an expanding workforce with layoffs, right? Because again, if you were to go look at a lot of the metrics, look at hires. Hires are now well below their pre-pandemic high, right? The pre-pandemic high was at around 5.95 million, 6 million. It was 6 million. It was a 6 million. Now it's at 5.34 million. The last time total non-farm hires were this low was back in 2017. So that's actually pretty low, right? Companies aren't really hiring how they have been in many, many years. So they're not hiring. So the people that are entering into the workforce are having a hard time finding a job. If you get laid off, which the layoffs are still relatively low, people are having a harder time though finding a new job. And that's why continue claims are actually, quite a bit higher, right? They're at 1.88 million. And this is the highest they've been really since since this pandemic. But again, going back to the Sahm Rule, one thing to consider, and I've said this before, is that recessions, they're like a virus, right? They start in certain parts of the country and then they slowly spread. They don't just pop up in the entire country immediately unless you have a black swan like the pandemic, right? If you have a black swan like the pandemic, sure. Then they can just go from everything's fine to everything's not fine overnight. But there's actually a really great way to visualize this. And so we added this here. So what we're going to look at, let me just isolate Sahm Rule stuff. So we're going to look at a map of the states where the Sahm Rule has triggered. Okay? So now if you live in the United States, think about, okay, what state do you live in? Has the Sahm Rule triggered where you are? I will say, in her defense, Claudia Sahm has said many, many times that the Sahm Rule was not developed with the state level in mind, and therefore it should not be used at the state level. So, if we were being responsible, we would not use it at the state level. But we're more about dubious speculation here. I'm going to use it at the state level because I just want to see what's going on. And what you'll notice is that pockets of the country will show weakness first, right? And then it'll slowly spread. I want to show you what the other recessions look like. Look at the map right now. Look at what it looked like in December of 2008. Everywhere it was in a recession, right? Look at what it was in February of 2022. Basically everywhere, with the exception of two states, right? With the exception of two states, were had the Sahm Rule trigger. And you can go back and look at very similar things in prior recessions, right? Now, what I'm going to do is I'm going to play this for you. So we're just looking at it. It's going through 1977. So you can see how sometimes some of the states will trigger, but it doesn't lead to a full-blown recession. And then you sometimes do get full-blown recessions where the virus spreads to the entire country, like it is right here in the 1980s. But then you go through the mid-1980s and you'll see some states pop up as having the Sahm Rule triggered, but then they just kind of go back, right? And the virus doesn't spread. Again, here, the virus starts and then it spreads. And then it affects enough of the country to where you get a recession. Now we're in the mid-1990s. You should see some of them start to pop up again. There was a scare in the mid-1990s, but then it went away. And then we had another one start to pop up here as you got into the late 90s and then early 2000s. and then the virus spread to basically the entire country, and then you had a recession, right? And now you're about to see in a couple seconds, you're going to see the financial crisis occur, where you get a few states, and then it picks up, and then essentially the entire country is in a recession. And then we go through this period, in the 2010s, where you didn't really have a recession, right? I mean, you had a few states pop up here and there, but look at this. I mean, we're going through all these years, and there's basically none of these states, for the most part, are even triggering the Sahm Rule. And then as you get into 2020, everything at once, right? Because you had a black swan. And then it's been, it was quiet for a while, and then we had it pick up in 2023. There was a scare, and this is what it looks like today. So if you were to go back, if you just were to look at the last couple of years and fast forward through this, like, you can see that various pockets of the country have experienced a softening labor market, but it hasn't really completely spread, right? Like, it hasn't really spread into these regions right here. It's on the West Coast, and over here in like Missouri and Illinois and Kentucky and Ohio and West Virginia, and a little bit down here in the South. But that's about it, right? That's about it. And what you can do actually is we can count the number of states where the Sahm Rule has triggered as a function of time. And when you look at that, we know that it's been 18. It actually just dropped from June, or from, if you look at the last couple of months, right, it was at 22 states. Now it's actually dropped back down to 18. So when you look at it like that, I don't know what's going on. I mean, at a national level, it's starting to pick up, but we just saw it drop down. Now, that's not completely unheard of. If you were to look at, the 1990s recession, it dropped down and then it shot back up, right? So it's not like it can't do that, but you haven't really seen that as much in these two cycles right here, okay? So that'll be something to keep an eye on. Does that actually go back up? And you can actually go look at it at a state level, right? This is the Sahm Rule recession indicator at a state level. And you can see that in some states it has triggered, right? Here's Alabama. It triggered. California is triggered, right? It's above that level. If you were to look at the District of Columbia, it just re-triggered after untriggering for a while. Florida is an interesting one to follow. That is, I guess it just triggered, right? It just did trigger. If you were to look at Idaho, it hasn't, right? It's kind of close, right? It's 0.4, still didn't trigger yet. Massachusetts is always an interesting one to look at because, it's been relatively strong in terms of labor market. And you can see it hasn't triggered, and it's also not even that close to triggering, 0.133%. Rhode Island is one that I actually like to take a look at from time to time. Rhode Island is an interesting one. It triggered long ago, right? And now forget 0.5, it's at 1.6 in terms of the Sahm Rule, right? 0.5 is all you need. Texas, always an interesting one to look at. You wouldn't know anything's wrong if you just looked at Texas. 0.1, it's nowhere close. So it's one of those things where it is starting to spread, right? Like, the virus is starting to spread. And at a national level, you can see that it is really starting to pick up. With that said, there are plenty of regions of the country where the labor market hasn't really softened up that much. Now, things can change really quickly is the problem. And I'm guessing that the Fed's going to come in with some rate cuts pretty soon, probably in September. They could theoretically do an emergency rate cut before then, but it's even hard to imagine. I mean, like, the problem for the Fed is that real GDP is still pretty strong, according to the Atlanta Fed. I mean, they're forecasting it well over 2.5% or something. And inflation is not necessarily yet on a durable path to 2%. If you were to go look at inflation year over year, yes, it's below 3. So what? In the 1970s, it got below 3 in the summer of the election year, and then it went right back up. So sometimes when I look at these probabilities in terms of rate cuts, and the market went essentially from pricing in 2 or 3 rate cuts to then changing it, right? Now the market is pricing in, earlier today, it was actually a much higher probability of 50 basis points. Now it's back to 25, but it's crazy how quickly this stuff changes, right? I mean, again, I was looking at it earlier, and they were pricing in 50 basis point rate cuts. Now it looks like it's shifted back over to 25. So I guess cooler heads have prevailed. But it just goes to show you how quickly things can change, right? The market certainly doesn't know what's going to happen. And also, normally the Fed doesn't just cut 25 basis points, like this forever, right? They don't just do 25 at each meeting. It's probably going to be something different than that. So we'll see what happens. But the Sahm Rule has triggered, right? So, whether you think it's important or not, there is at least a good chance that there will be at least some type of recession. It might not be a recession that has to compare to the dot-com crash or the financial crisis. Maybe it's more comparable to what happened in the 1990s or in the early 1980s or maybe the 1970s, right? Or the 1950s. They're all kind of different. And I think you probably should look at this one and say, it's probably going to be somewhat different than all the ones that came before it because the market evolves and it does something different, right? And if you're wondering why, if you think that if there's definitely a recession coming, if you're wondering why is the market not priced that in yet, well, as I showed you, when you look at the map of the states where the rule is triggered, who knows? Like what happens if it just ends up being something like this in the 70s where you sort of get it, but then it just kind of goes away. And then it doesn't pop back up for another year or two. So that's why, like, the market is starting to price in a higher probability of a recession. But it doesn't mean that you necessarily have to get a financial crisis or a dot-com recession. Now, if you get something like that, so be it, right? I mean, it would actually lead to a huge opportunity for investors because, I mean, I'm a millennial, right? I was born in 1990, and I've never really seen, I mean, apart from the pandemic, right? I mean, I've never really seen a recession. So, I mean, if anything, they just present opportunities. And also the other thing too, I mean, it's really hard. Obviously, people get laid off, which is, I mean, something that we should not minimize, right? It really does lead to hard times. But the positive side of it is that it helps people focus on businesses that are more useful to society as the frothier companies that don't provide as much value go out of business. So that's one of the sort of the silver linings of them is it actually ultimately it makes the economy stronger if you can have a multi-year outlook. Of course, if you only care about the next 6 months or the next 3 months, that's where things get a bit more hazy. And we did get a lot of other, data that came in, right? I mean, if you were to look at some of the unemployment data that came in, one of the things I like to look at is the job openings per unemployment level. So that dropped slightly to 1.2. So there's still about 20% more job openings than available workers. Now, you might say the data is not to be trusted, but again, I don't care, right? I mean, this is what the Fed uses, and the policy decisions they make are based on things like this. So whether you believe it or not, it does affect what the Fed does, right? It contributes to their reaction function. And therefore, it contributes to how well your altcoin is going to do. So it is important whether you think the data is important or trustworthy or not. But I mean, if we were to go through some of the data that came in, right? So you have the unemployment level, and I mean it is really starting to pick up here, right? I mean, just take a look, right? It's starting to really pick up. Here's an unemployment level by reason, right? So job losers starting to go up, right? It's starting to go up. It's the highest level we've seen in a while. We have job losers on temporary layoff. That shot up a lot recently. You got permanent job losers, which hasn't really gone up a ton in the recent month or so. New entrants to the labor force. This is one that often contributes to recessions early on, right? As new people come in. We talked about this before, right? First, it's new people coming into the labor market that lead to the unemployment rate going higher because they can't find a job because people aren't hiring, as we showed with the hiring rate earlier. That's what happens first, right? Then later, it can be people losing their job, right? That tends to come out in the later part of the cycle if the Fed doesn't cut rates quick enough. You can also have re-entrants to the labor force. That's also starting to go up, right? So people who used to have a job, now they're trying to come back into the labor market. That's starting to go up fairly quickly. So again, the unemployment rate did end up coming in at 4.3%. It is starting to really move here, as you can see. If you were to take, say, a 3-month moving average, I mean, it really does look like it's built out a pretty large base down here, and it's going to start going higher. And the issue for the unemployment rate, the issue for the labor market is, think about how long it took to get this to move up for the Fed, right? I mean, how long it took for them to soften up the labor market. A 25 basis point rate cut isn't going to do a thing to slow this down, right? I mean, maybe a tiny, tiny bit, but if it took 2.5 years to see the unemployment rate really start to move up quickly, should we be under the impression that a 25 basis point rate cut is going to all of a sudden make things better? Probably not, right? I mean, it would probably take several hundred basis points of rate cuts. And even then, it's not like it's going to play out immediately. Again, the business cycle takes years to play out. If you were to look at the number of states where the unemployment rate is rising over the last 6 months, currently 22 states. Okay. Last couple of years, though, it did go up into Q4, right? This was, October, November, right? This is October, November, December, right? So it could very well go up into Q4. Alternative unemployment rate measures. This is the greater than 15 weeks unemployed. That was a big move up recently, right? I mean, 1.3% in April, 1.6 today, right? Like, that's a pretty large move up over the last few months. It's noticeable on the chart, right? It's very much noticeable on the chart. You could also look at unemployed plus discouraged workers. I mean, again, a lot of these, it looks like it's really building out a base down here and starting to move higher. We have the labor force participation rate. We have the civilian labor force level. Okay. This is an interesting one. This is the employment level. This is two different surveys, where the establishment survey still looks pretty strong. Although if you look at a month over month percentage change, it is starting to slow down here, right? Like, you can see it's slow. It's really starting to slow down. But if you look at the household, that's where it tells almost a completely different story, right? In fact, if you were to look at the year over year percentage change of the household survey, it's almost negative, right? It's actually at 0.035%. In fact, it might go negative next month, because if you go back and look, this was for July. If you go back a year ago in July, you can see that it actually still went higher in August and September. And so if this doesn't go up the next couple of months, then when you look at the year over year percentage change, it'll actually print a negative number. And the reason why that's important is because, as you can see, when it goes negative, you typically have recessions. Not always, but typically. Here's an example in 1952 where you did not get a recession even though it went negative. So just something to think about. You also have non-farm private payroll employment level. Year over year percentage change shows that it has been dropping pretty steadily up until maybe a couple of months ago, and then it perhaps it started to accelerate a little bit. The year over year percentage change is now down to 1.35%. Total temporary help service employees continues to drop, but look, it's been doing that forever, and it really hasn't meant anything. So I don't really know if it's going to start meaning something now or not, but it hasn't. It's been dropping basically since the Fed started cutting rates. I mean, look, the Fed started cutting rates in early 2022, and this has been dropping since March of 2022. Okay. And then you also have like job postings on Indeed, which is kind of an interesting one, where it's normalized to sort of pre-pandemic, and then you can see where it is today, right? This is about 13% above. We also have job openings. Job openings continues to slowly come down. This is total non-farm. One of the reasons job openings is so high, though, is because of the government, right? If you look at total government, job openings just shot back up. If you look at state and local, it just shot back up. But then if you look at all these other categories like private, we lost 102,000, right? Job openings. If you look at construction, right, lost 71,000. Manufacturing, lost 100,000. Durable goods, lost 88,000. Non-durable goods, lost 11,000. But then you go look at total government and you're like, oh, plus 56K, or state and local, oh, plus 118K. So it's mostly coming from the government, is where those job openings are even coming from. The job quits level continues to be in a downtrend there, which, basically the way to think about this, as you go into recessions, people quit their job less because they're unable to find new jobs, therefore they're not quitting, or they don't quit because they're fearful they won't be able to find a new job even if they do quit. And so going back to initial claims, that's still relatively low, although it is starting to pick up. And hires, we already talked about that one, right? That's pretty low now. Maybe worthwhile to check in on some of these. This Kansas City Fed Labor Market Conditions Index. Still pretty high right now, honestly. I mean, still not close to being negative. Although if you look at .com, it was recessionary before it went negative. And then here's the labor market conditions is at the momentum indicator, so you can see where that is. And I mean, here you can see that it's really not in the same sort of category yet as these last two recessions. So, that's at least maybe one silver lining in all this. But that more or less wraps it up for all the different indicators. The other thing I'd like to take a look at, we do have a recession risk dashboard, and the only things that are starting to show some concern, the interest rates have obviously been showing concern for a long time, right? Like if you look at the risk in that, it's been really high for a long time, but it can stay high for a long time before it means anything. Where it's starting to pick up a little bit is in the employment data. I mean, if you look at national income and product and production and business, the risk levels are still relatively low. And that's my point, right? The labor market's showing some weakness, but the economy in and of itself, I mean, it's still theoretically growing at this point if the Atlanta Fed is correct. And at least Q1 and Q2 saw growth. And so if Q3 shows growth and you also have a softening labor market, there's that balance of risks that comes in. You can see that the labor market risks are starting to get off zero a little bit, right? I mean, all these are basically just 0.0 something, right? 0.01, 0.09, 0.03, 0.01, and 0.09. Same thing over here, right? And even this one's 0.008. Where it starts to get off that 0.0 is in some of the labor market data. Okay, some of the labor market data. For instance, initial claims risk is at 0.1133, right? It's starting to go up a little bit. I mean, it's higher than it's been, but that doesn't mean it's going to go all the way up here. We don't know yet, right? We don't have enough data to know. If you were to look at job openings risk, it's at 0.269, so it's dropped a little bit. Where it's starting to pick up some, this is loading still, is the unemployment rate risk. It's currently at 0.122. So this risk is starting to go up. So there are times in history where it spikes like this and you don't get a recession, right? Here's an example in 1951, right? It spiked up and you didn't get a recession. So there is still a chance that you don't get one. But looking at the unemployment rate and how quickly it's starting to move up, it would stand to reason that there's a decent chance it will continue to go higher. Therefore, the unemployment rate risk would theoretically go higher. So we'll see if that materializes into anything a little bit more concrete. But that's where we stand with the labor market. That is where we stand with the Sahm Rule. I do hope that the Sahm Rule, this video has been helpful. I know I went off on some of the tangents, but I just wanted to cover a lot of the labor market data that came in. As I said at the beginning of the video, right, like just because it triggers doesn't necessarily mean that risk assets have to respond immediately, if at all, especially when you look at the 1950s. You can see sort of the spectrum, where in the 1950s, basically nothing happened and the market still went up, to the 2000 decade where you had 50% drops in the market. This is a problem, right? Because, I mean, I think a lot of people think that they can time the market and they can predict exactly what the market's going to do. But when you look at all the prior examples, you have to be kind of humbled by it and say, who knows what's going to happen? I don't. But I will at least show you the data so that you can hopefully make better decisions for yourself. I think the point is to just have a plan no matter what, right? I mean, for me, that plan has been to basically stick with Bitcoin for the last several years. Obviously, I also have DCA'd. And I also have, low expense ratio index funds whenever the risk levels are, allow for it. But that's, I think it's important to be hedged, right? And also, I mean, I also, had some hedges in gold and in fixed income and in bonds, which have done pretty well recently. So, I mean, it really depends on what your goals are. And I think as an investor, it makes sense to be properly diversified, right? You have some hedges in case the recession risk really does materialize. But, if you just stick with 100% cash forever, you're going to lose your purchasing power. So you got to have a good mix, I think, to be successful. And you look back in 50 years or however long, you'll probably be doing just fine, and these times won't mean anything to you. But in the short term, obviously, it can be somewhat scary if you're looking at all these recession indicators that we've studied before, and now they're finally starting to flash some warning signals. So again, we'll see what happens. Um, there's also this other one, the smooth recession probabilities indicator. And this is still pretty low, right? I mean, as of June, the probability that we were in a recession was only 0.16%, right? So take it for what you will. This probably will change relatively soon. You can see it was last updated on August 1st. Once we get the next data point for this, the beginning of next month, it'll probably be a bit higher because the unemployment rate. We just got the unemployment rate data that actually went up quite a bit. So we'll go ahead and wrap it up there. Thank you guys for tuning in. Make sure you subscribe, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.